The first week of the lectures, we covered 3 chapters. The first 2 were relatively straightforward. Chapter 1 was corporate structure, and then a review of financial statements. And then the bulk of this lecture was on capital budgeting. So let me go over briefly corporate structure first. There are 3 different types of corporate structures or business structures. The first one is a sole proprietorship. And this is one that most companies will start as. If you're starting a business, it's essentially a business that's owned by an individual. So you are running a business, but you have not incorporated, and you could be just running it out of your garage. Like when Amazon started, Jeff Bezos ran it out of his garage as a sole proprietorship. And any income that you earn from the business will get added to your personal taxes. Okay, so it's added to your personal tax. So you're not doing a separate tax return for this business. You're just calculating the income and adding it. And the downside is you will have personal liability. So if somebody decides to sue the business, they're suing you as well, and they could take your house or any of the other assets if they're successful. The second one is similar to a sole proprietorship, but if there's more than one person involved, then you would start a partnership. Okay. So I'll say it's like a sole proprietorship. But it has 2 or more people, or 2 or more owners. Okay. A common example was Apple. Steve Jobs, Steve Wozniak started it originally as a partnership, and then it grew pretty quickly. And then the last one is the one that we will talk about most in this course. It's a corporation. So if you are going to, usually when you get to a certain stage, companies will incorporate, and this becomes a separate legal entity. Okay, so unlike sole proprietorship, you're not going to add their income. This will have a corporate tax return. So they do their own taxes. This is like a separate individual according to the government. And a corporation can be it can either be a private or it can be a public corporation. And the only difference is that a public corporation is one where shares trade on an exchange, on a public exchange. So it could be any public exchange in the world. Once you're listed, you are public. Okay. One of the big benefits of this is there is a limited liability. Okay, so if you are going to sue Amazon, you can sue Amazon and get whatever judgment you wish against Amazon, but you can't sue. You can't get Jeff Bezos to pay the money for it because he's just a shareholder of Amazon. Okay, so a couple of the pros. So why do people do it, or why not just leave it as a partnership or a sole proprietorship? The biggest one is the limited liability. The next thing is it gives you an unlimited life. Okay, so unlike an individual sole proprietorship, when the person dies, then the business is over. A corporation keeps going regardless of the life of a shareholder. Makes it easier to transfer ownership. So it's very easy to sell shares of Apple, much more difficult to sell your business if you're the owner and you did not incorporate. And it's also easier to raise capital. So if you need money, and you want to issue shares, usually for public corporations, they will just issue shares on the market where they're listed. Okay? And the structure of a corporation, essentially at the top, you have shareholders. So they essentially own the corporation. They will appoint the board of directors. And this is done at annual meetings. And then the board of directors in turn will appoint the management team. And this is the group of people that actually run the company on the day-to-day basis. So it'll be like the CFO, the CEO, and all of the other senior executives. And the goal of any corporation in this textbook in finance is to maximize shareholder value. So we'll come back to that again in the future. And you could say maximizing shareholder value, a good measure of that is share price, because shareholders want to see the price of the company increasing.